And I just started recording the presentation, so I'm going to say again, welcome to Arla and Aaron from BA Harris. Since all the members of AVID Investors Club can't and don't join in the same fashion on Zoom, we might go ahead and share this recording after the fact to help bring the presentation to them.
Thank you. And Stacy, I think you were going to go ahead and open up. If there were questions, you can ask them along the way. She's got the little question bubble open, so
the chat box at the bottom of your Zoom screen, and also the reactions, we'll be monitoring those. And if you don't feel like interrupting, but you have a question, you don't have to type the whole question. You can just type your name in there, and we'll consider that. We'll look for a good moment to pause and let you ask it.
Well, all right. Well, I thought we would start this off by kind of taking a look at the ordinary income brackets for 2020 and kind of get a review of where we're at right now, where things sit. I think a lot of people, I know we've gotten a lot of questions with the new administration. I think a lot of people are getting nervous as to what the moves are going to be in the near future. I've kind of sprinkled in some things that the Biden administration has spoken about during their campaigning and since the election. So hopefully that can kind of clear things up. I wouldn't get too worked up thinking that things are going to explode. I know President Biden's made a lot of big promises, but the idea that he's going to use a lot of political clout and make a ton of huge changes kind of seems a little out of the realm of possibility, especially because a lot of these changes are set to sunset at the end of 2025. So it seems like it'd be a pretty strange political move to exert a bunch of force to try to get things changed for things that are just going to end up reverting back to the way that they were in the Obama administration in a few years. But anyway, so here's where things currently sit at the ordinary in the ordinary rates. Click over to 2021. So not a huge change for 2021. The only thing I wanted to point out was that the Biden administration has proposed raising the top individual income tax rate to 39.6%. I mean, that could be as early as he can possibly push that through. I mean, I know he's got a lot of things on his plate right now, just trying to get the new stimulus through. So I don't know how high on the docket this is, but it's something to keep in mind going forward. And when I mentioned that in 2025, the Tax Cut and Jobs Act sunsets, that'll also eliminate the 20% Section 199A deduction for qualifying rental activities. I'd love to get into talk some Section 199A right now. That's kind of that could be a half hour, an hour long conversation as it is. But yeah, so that is set to expire at the end of 2025, and we'll see if that holds, because that could always be extended. So we'll see. So here's the 2020 and 2021 long-term capital gains rates. Yeah, so President Biden has also proposed that taxpayers making over $1 million pay the top proposed tax rate of 39.6% on capital gains. This would be a big deal. You're sitting on a piece of property that has, a lot of equity in it. You're thinking about maybe selling and taking those gains. Well, if you're in the top tax bracket, you're looking at, instead of a 20% tax on your capital gains, you're looking at potentially 39.6. So that could sting. Again, we're not sure if that's actually going to happen. Just something to keep in mind.
Yeah. And I'll probably interject a little bit every now and then too. My personal opinion is I do not think that would get through Congress, even though Democrats are a majority, or at least they can be. But I still think that there's a lot of people that think there's a lot of value in investing and having that capital gains rate at a different rate than ordinary income. But never say never. So.
Yeah, I mean,
when would those take place? Those changes?
Oh, it could take place as soon as he can get it put up for a vote. But like Arla said, there's a lot of people in the government who own property. So I would have a hard time imagining that this is actually going to pass. So, and the idea is that there's so much capital gains that aren't being taxed. People are just holding on to them. The idea is, well, let's just tax them higher when they eventually recognize those gains. Well, that's not really going to entice many people to recognize those gains if they know they're going to get smashed with a 39.6% tax. So I'm not sure if this is actually the route that people are going to want to take. So just wanted to give people the heads up on the Idaho 60% capital gain deduction for qualifying properties, real property held for over 12 months. So make sure that if you want to take advantage of that, that you're holding on to your property for at least a year.
Yeah, that's a really great benefit for residents of Idaho. I mean, it applies to anyone that owns the property, whether they're out of state or not. But if they are from out of state, they still have to pay the difference in their state tax. But that's a really low rate. So when you look at some of these brackets, you've got, you know, the 15% kicks in at 500,000 for or kicks in, at 500, sorry. It applies at 500,000. Is that correct, Aaron? It starts applying then, right?
Yeah.
And then you go to 20% after that. Well, those numbers are the same. I think you got wrong numbers on that second line.
Okay. Well, no, it goes, okay, it goes until 500,000. After 500,000.
Oh, 500,000, it goes to 20.
Yeah.
To 20%. Yeah, sorry.
Yeah.
Anyway, so those late rates at 15% federal and basically 3% Idaho, those are historically low. So, you know, it's not the worst thing if you were to recognize gains at this point in time in history.
Yeah, and again, we want to make sure that you're holding on to that property for 12 months. I know things are, like we mentioned at the top, that everything's just exploding. I actually had a client ask about, well, I mean, I've had this property for 8 months. Is there any way that can prorate over the 8 months? And fortunately, I had to hold it for the 12. So I know a lot of people have properties just burning a hole in their pockets, but you might want to hold on to it for a few more months if that's at all possible. Okay, so let's say that there's nothing left for you to do and you just have to sell these properties. And is there any way that you can get out of potentially paying some of the tax on these gains? Just wanted to go give a brief overview on the 1031 exchanges. I believe Arla, was it 2018 that this changed only for real property?
Correct. Well, yes, that's correct.
Yeah, I remember
it used to be that there were exchanges available for personal, not personal use property, but personal property such as, you know, desks, whatever, cars.
Sure.
And so then it did change to be just real property.
Yeah, I was gonna say the old standard example when I was in school was the pizza truck, and that no longer applies. So it's got to be real property and qualified like-kind property. So it can be business, investment. It can be just raw land. It can be you know, raw land for a building. Doesn't matter. It just has to be real property. Yeah, we kind of go over the how to calculate your basis here: selling expenses, commissions, legal, title, company fees to get added back to the basis. Yeah, and Arla always likes to keep people in the loop that if you're working with the California investor, that a California return has to be filed until the final disposition of that California property. Because California wants to make sure that it gets its share.
Yep.
So a Biden senior, I hesitate to even bring this up because I know a lot of people get upset about this, but a Biden senior campaign official has mentioned that the administration will try to get rid of the 1031 exchanges. Just feel like I have to mention that, but I again really highly doubt that this will actually happen. if that's the case, I'm not sure how many people are familiar with opportunity zones. I kind of passed on throwing a slide up on those because those can get really into the weeds. But that'll probably be your best bet in abating some of these capital gains taxes. But again, highly doubtful that's going to happen. Just wanted to make people aware. Installment sales. So if you don't want to recognize a gain in 1 year, you're thinking, you know, my taxable income is going to be lower in later years. I'd rather recognize this gain over a number of years as opposed to just taking the hit all at once. If you can set up your sale as an installment sale, you can recognize your gains over any number of years. So the sale of property paid for by installment payments that span more than 1 year, if it's over, it has to occur in more than one taxable year. So if you're just getting installment sales over a series of months in the same taxable year, that's not going to really accomplish what you're trying to accomplish. So, so taxpayers can pay taxes on the sale or other disposition of property over time when the payments from the installment sale are actually received, as opposed to recognizing the entire gain in the year of disposition. You can actually also elect, if you, for whatever reason, you've set up your sale as an installment sale over a number of years, you can actually elect to recognize the entire gain in the year of disposition. If you feel like, oh, I'm in a low tax bracket right now, the taxes will be low this year, I'll just recognize this whole gain this year, even though I'm actually going to be receiving the payments over a number of years. I'll just take the hit now because it'll probably be more beneficial for me to do it that way.
Yeah, and that's a good point, because let's say, you know, right now you're working, you're earning, you know, 100,000 a year, and then all of a sudden, but you're looking towards retirement and you've got these gains, you know, yeah, you're going to want to make sure that you don't, even if you're selling it now, if there's some way of deferring some of that gain into future years when your other income is going to be smaller, that's a wise move.
Yeah. Yeah, and I mean, if you're worried about taxes raising in the future, or you feel like you're going to be making more in the future, that might be a good reason just to recognize it all right now. Losses can't be deferred through installment sale. The entire loss has to be claimed in the year of disposition. And if the sold property is a capital asset held for longer than 1 year, then it maintains its long-term capital status, capital gain status. Otherwise, the gain is taxed to ordinary income. So again, so say you have that, going back to that client, and he has that rental property for 8 months and then sells it under an installment sale. That's not going to change the makeup of his gain just because he's not receiving his payments until over a year. It's going to still be an ordinary or short-term capital gain because the initial disposition occurred under a year. So really quick, some of this stuff here that isn't necessarily real estate related. So the SECURE Act increased the age for required minimum distributions of retirement funds from 72 to from 70 and a half to 72. And if you inherit an IRA, you used to be able to, so say I were to inherit an IRA, I would be able to take distributions out of that based off of my life expectancy. But now that's been shortened to actually, you have to empty that account in full within 10 years. Age restrictions have been removed for traditional IRA contributions. Roths never have had an age restriction, just as long as you have earned income. 529 plans, you can use for student loan debt. This has been beneficial for our clients who are out of college making more money than they ever have been. They've got obviously student loans to pay, making too much money to deduct the student loan interest. If they filter their payments for their student loan interest through a 529 plan, they're able to take some of that off of their state taxable income, which is nice. And then they SECURE Act introduced some small business credits for starting retirement plans. Has anyone here heard about this Idaho first-time home buyer savings account? I've asked a few people, and for some reason this doesn't seem to be a hot topic. I wish this was available when I was first buying my first home, but it works in the similar fashion as a 529 plan or a medical savings account. You basically can contribute up to $30,000 for married couple into basically a glorified bank account, and then you can subtract that amount out of your Idaho taxable income. And as long as you go to buy your first home in Idaho, you can withdraw from that account, and there's no penalties or anything. You just get to deduct that amount from your state taxes at the end of the year. It's a pretty nice deal. So I mean, if you have $10, $15, $30,000 sitting around for your down payment, just open up one of these accounts. It's really easy. You can set them up through Idaho Central Credit Union has them. If you're already a member of that bank, it's really easy. You just go online and set it up. Just deposit those funds, let it sit for 30 days, and then make the down payment and subtract 30 grand off of your state taxes. So it's pretty nice.
Aaron, Ryan had a question on this is on a personal level. So, for first time home buyers for their personal residence, but when was that enacted?
It was, I want to say it was during the summer last year.
Yeah, I think it was, it was either part of the Secure Act or the CARES Act. So it was right within that time, but yeah.
Yeah. Shameless plug. I actually wrote a blog about that. If you're interested in reading more about that, it seems to be the only resource for that little tidbit of information. Yeah, it's a pretty neat deal. It doesn't seem like many people are aware of it. So, stimulus checks. Everybody's been talking about those. It'll be based on your 2020 tax return. So if you, for whatever reason, didn't receive enough of your stimulus check, you didn't receive it at all, you can be credited the difference on your 2020 return. And if you receive too much, then congratulations, you win.
Yeah.
And yeah, there's a proposed stimulus. I'm sure people are aware of this. $1,400 for 2021. That vote's going to be held next week. So we'll see how that all shakes out. $300 of charitable contributions can now be above the line, at least for 2020. So, I mean, ever since the standard deduction was raised pretty high, a lot of people kind of think that, well, I'm not going to itemize my charitable deductions, don't really do anything for me. Now, because of the coronavirus, we're being allowed $300 above the line. So regardless of whether or not you itemize or not, you can get $300 taken out above the line. So kind of a nice little deal. And that increases to $600 for married filing joint in 2021. So the $300 is for every tax return. So married filing joint, single, doesn't matter. But then 2021 is $300 per taxpayer. Business meals are 100% deductible in 2021 to 2022. It used to be only 50%. So go ahead and order that second drink, I guess.
When those restaurants open back up. Or
when you're
bold enough to go to them.
Okay, so section 121. This is the gain exclusion for the sale of your personal residence. So the $500,000 max exclusion for married filing joint, $250,000 for single filers. You have to pass 3 tests. So you have to have owned the home for 2 of the last 5 years preceding the sale. You have to have used the home as your principal residence for 2 of the 5 preceding years. And you haven't taken advantage of section 121 in the 2 years preceding the sale. So this is available every 2 years, essentially. Wanted to throw in there, you could also, so as long as you moved in there into your home first, you could actually rent it. I know a lot of times, you're in the process of selling your home, but you you've bought your new home, you're in the process of selling your other home, you have to take some time, you're renting that you will still qualify for your section 121 exclusion. It gets a little hairier when you moved into a rental property, and so you purchased a rental property, rented it for a few years, then moved into it, and now you're thinking of selling it. That calculation gets a little in the weeds, but you will still get a partial exclusion in that case. For any landlords out there, second round of payroll protection plans loans are now available. To qualify, you must have experienced at least a 25% reduction in gross receipts between comparable quarters in 2019 and 2020. So you'll just choose a quarter from 2020, compare it to the same quarter in 2019, and there's a 25% reduction in gross receipts, you'll qualify. Loans are eligible for full forgiveness, and they're simplified forgiveness plans for people who only take out $150,000 PPP loans. And that's it.
Hey, Aaron, I think one of the other things we were thinking about is to kind of explain on the capital gains rate schedule, how that works, how you fall in those.
Oh, sure. Right. Yeah. So how those interplay with each other. Sure. So I always think of it, I mean, this is when I was in school, how I thought about it was you want capital gains rates. That's the frosting, right? So your ordinary income is going to be taxed first. So that's going to be, let's go back and see.
Yeah, I was going to say, why don't you pull up those schedules again?
Yeah, let's do that. Oh. All right. So, oops. Let's say it's 2021 and you have your ordinary income, and let's say you're single and you made $40,000 last year. So that's going to be your base. That's going to put you up into the 12% bracket for your ordinary income. And then let's say you made you had $20,000 in capital gains on top of that, long-term capital gains on top of that. So to know what your capital gains rates are going to be taxed at, you're going to first find what your ordinary income was. So that's going to be the 40,000. And then you'll come over here to this 2021 table over here. And it looks like you'll be in the 15% bracket because you've already used up your 0%. So if you made no money and all you had was capital gains up to $40,000, you'd be taxed at 0%. Since you had ordinary income of 40-something thousand, you've bumped yourself out of the 0% bracket. And now any capital gains or icing or frosting, or whatever you want to think about it, that you get on top is only going to be taxed at the 15%, as opposed to the higher ordinary income rates. So. I hope that helps. Clarify some of this stuff. You know, it's kind of a 3,000-foot view at some of this, but.
One of the other things I was kind of mention on 1031s too. I mean, people get pretty excited about doing a 1031 to delay that gain, and that's extremely useful. Gives you more buying power, of course, but occasionally, and that could be now for people here, is you don't want to overspend for a property just to defer the gain. So it's really, certainly we don't know how much higher the market's going to go, but it's pretty hard to find a deal right now. So if you're paying 15% more than you normally would for for a property, then you might as well go ahead and not overpay and pay the capital gains rates, because you'll be up in the same bucket, but you won't be taking a loss later on the property. So it's just it's kind of a personal decision, but and I guess, of course, you could also 1031. You do not have to 1031 into property in this state too. you can always 1031 anywhere else within the United States.
Did someone ask a question? $1031ing into land is a question that came up on the chat box, Arla.
Oh yeah, you can, as long as it's real property, yes. The only thing when you 1031 exchange into land, if you're using a rental property, anything that has been the depreciation, the accumulated depreciation that you have in that relinquished property would need to be recognized, but otherwise it's fine. Yeah, you can 1031 land into rental property as long as it's real property.
So 1031ing defers the taxes. Doing an owner carry or an installment sale also defers taxes, or it spreads them out. With 1031ing, you can keep deferring, and eventually if you die, there's a step up in basis, so your estate may never have to pay the tax. But if that's not what you do, eventually you will pay the taxes. And something notable that you said was that tax rates for capital gains are historically low at the moment. So if your income were to be the same in the future as it is now, it might be a more favorable time to go ahead and pay out Uncle Sam because of said low rates, unless there's something you can really do more so with having a larger chunk of change right now. Is that accurate, Arla?
Yes, that is. And the only other thing I was going to add in there too is, we always encourage people to plan these out before you jump, and check with your tax advisor as to, whether it be better to wait a year or depending on, because they can do estimates for you based on your current year income, what you think your projected income is going to be, when would be the best time to go ahead and take that gain. And and also whether you have any other types of capital losses. Right now, stock market's been doing great too, so people don't have huge capital losses sitting out there. But if you've got capital loss carry forwards from several years ago, you're not going to want to exchange, because then you can use up those losses. So it's just really always, I think, checking with your tax advisor and knowing what the effects are before you make those decisions.
And what do you think, Arla? You mentioned a great opinion that I think is really valuable about not overpaying for a property, by more than your capital gains savings at the very least, or not overpaying because you're more motivated because you have a 1031 exchange. But I see a lot of investors not wanting to sell because they don't know what they do with the money and they don't want to take the tax hit. So to them, what do you think?
As I said before too, it is kind of personal, but when selling now there's kind of two thoughts there. I mean, yes, the market will probably keep growing, but for how long is not certain. So, at some point it will change around. That's just the nature of real estate. So if you go out now, get out now, and you don't know what to do with your cash, I mean, there's certainly a lot of options there. I think talking to an investment advisor too, as far as where you want to invest that, even if it's in fairly safe investments that are maybe earning a lower rate. But there's a lot of different options you have, really. I mean, you can loan that money to other people at a higher rate than what if someone, let's say, has some bad credit and they can't get a loan. So there's different things you can do with that money. It doesn't have to sit there and not do anything. So.
Well, and also that brings up a really good point, Arla, because in this market right now, with for folks who are looking for houses, if they don't have a ton of cash, that's really holding them back on their ability to buy. If you're wanting to buy in Idaho, in Boise, and you're losing out to cash offers who are releasing their appraisal contingencies. And so if you don't have enough cash to be able to release your appraisal contingency, because if it didn't appraise, you wouldn't have the ability to make up the delta, and your lender's only going to lend you a maximum of an amount, and you're already maxed out at that, it seems that there would be a growing market of needs for cash and even bridge loans or temporary loans so that people can simply compete in the marketplace. I was just having a conversation like that with some folks today. They're moving here, they've got money, they want to be by their grandkids, but they haven't sold their house yet. And so they were going to get a loan with a lower down payment and then sell their house and then go ahead and do a recast. Many lenders will recast your loan if you make a significant payment on it. They'll do that for free. It's not a refi. So that was their plan until they keep missing out on offers. And now we're looking at whether we could potentially use short-term money or a short-term loan to make them a cash buyer so they can simply win the bidding war.
Yeah. Yeah, I just think as an investor, I mean, there's kind of, it's different if you're an investor looking for your personal residence. Certainly on a personal residence, I think you're a little more pressed to try and get in there, you know, if that's what if you're trying to live here. So people are going to probably overpay a bit, but they're going to probably be holding it long-term. They're not looking at it as an investment, purely an investment. As an investor, you know, I think you got to look at it like, well, what's my overall plan? Why am I investing if it's, you know, if I'm not going to, if the margins are too thin right now? You know, it's obviously a lot of timing, but I just think that when people are, sometimes trying to, I don't think that the tax situation tail should wag the dog. So, you know, just be sure to take all that into consideration. And there's another question there. Let's see. What's the penalty for a 1031 if your selling amount is more than the property you're purchasing? Well, there's not a penalty there. I mean, you basically recognize some gain. And so, or all gain. If you want to defer your entire amount of gain, you're going to have to reinvest in at least fair market value, at least as much as the property that you sold. And also you have to consider that you're not any better off as far as the cash situation. In other words, if you obtained a higher loan to get to that same to that same price, that's considered boot, and you will be taxed on that difference too. So, but you can certainly do it as a partial. I mean, if you can't quite find that full amount, again, I would just get some estimates with your tax advisor, and you know, you can still may be able to defer a partial amount.
Lori, does that answer your question? Do you have a follow-up question on that, or does that answer it?
No, that answers it. Thank you.
Okay. Any other questions out there? So with that partial exchange, Arla, if you do a partial exchange, you're deferring some taxes, but you might be subject to more boot. I always have trouble wrapping my head around that one.
Well, when I say boot, it just really means that you took cash out and used a loan instead. So it's the same. If you receive cash, or if you receive a reduction in debt after the whole thing is said and done, which generally means you either have, you know, you've got a lower base property, a lower fair market value property. But if you end up with cash or reduced debt on the whole deal, overall, then you're going to pay gain on that portion of the cash that you received. However, let's say you have a gain of, you know, 300,000, and you found a property within, you know, 100,000 of the fair market value that you just gave up. You know, you may be able to defer 200,000, but not the full amount. You just have to pay the tax on the 100,000 that you're ending up keeping. So it gets a little complicated, but you don't have to use all of your proceeds, but certainly you have to use them to defer the full gain. And it just really depends what your margin is, whether you can defer a partial amount.
Okay. It's a tricky market out there, but it's good problems to have, because right now, if you're having capital gains, that means you've got equity and gains to be had. And like Aaron said, it was the icing in some ways. So think about what your thoughts are on the future of the market. One of the big things that Arla came back to a couple times is that it is a personal choice, and it's a choice we have to figure out how to make for ourselves. But there's equity. It's a good time to sell. If you think the market could go down, it's a great time to sell. If you think it's going to be harder and harder to own property in Idaho, then maybe you want to hold. But if you do sell and you're subject to just a big and imposing number of that amount that you're going to have to set aside for Uncle Sam, it seems like there's a few options. And one would be to do the capital 1031 exchange to defer it. One would be the, what do you call it? The owner carry note. But the interest rates are so low with banks right now that, it depends on how much money you're going to get there or going to ask for. And then I liked the other suggestion that came up through a conversation, Arla saying private loan. I think there's always a need for somebody who's looking to do stuff with money, and they may want to do a private loan. So you can simply put that money back to work for yourself, pay the taxes on it, and figure out a way to put it to new work. And I think that's really it. Like Shane says, maybe it's better just to pay the tax now with the low rates and then get away from the higher rates in the future. And I guess we'll all figure that out on a case-by-case basis. Shane and I are going to figure that out really soon because we have a property under contract and there's some equity in it. So good problems to have. But thank you all for coming. And if you guys have follow-up questions, you're welcome to stay online. But this has been so helpful. Aaron and Arla, I'm really grateful for you and your sharing your time and information with all of us. It's just so valuable. And Aaron, your blog, I will include that link in the follow-up so that we can look that up. And I do have a first-time home buyer who's closing in like 35 days. So we'll remind her to get that savings account.
Yeah, for sure. So those funds have to be in there for 30 days. So it's going to have to get on that ASAP. So, yeah.
And it's so good to see you guys. I cannot wait till we can all meet in person, hopefully safely very soon.
Yep. That is a big dog you have, Ryan.
Thanks. The background makes her look bigger than she actually is.
She's pretty.
Yeah, thank you.
Thank you, Stacy, very much.
Thank you.
Yeah, thank you for having us.
Thank you, Arla and Aaron.
Thanks,
everybody.
Thanks, Lori. Thanks, Rick. All right, signing off.
Bye-bye.
Bye.